In 1986, an auditor from Ernst Whinney drove to a multi-story building in Sacramento that ZZZ's Best company claimed to have restored after extensive water damage. The building was real. It was fully occupied, freshly finished, and physically consistent with the description in the company's records. ZZZ's Best had never performed any work there. According to the SEC enforcement record and the subsequent federal prosecution, Barry Minkow's associates had located a building under construction, paid the developer for access and a key, and staged a walkthrough of a job site that belonged to someone else entirely. Before the auditor was permitted onto the floor, he was asked to sign a confidentiality agreement restricting what he could disclose about the visit. The structural question this episode answers is not how a teenager fooled an auditor on a single afternoon. It is how an entire category of revenue, comprising the overwhelming majority of a publicly traded company's reported business, could be constructed from documents describing work that did not exist and survive an audit, an IPO, and a fairness opinion before it collapsed. The mechanism at the center of ZZZ's Best is the fabrication of an entire revenue line through what can be described as consignment recharacterization. The conversion of a small, real, low-margin service business into a fictional high-margin contract business that existed only on paper, and the use of that fictional business to support a public valuation. Begin with what was real. ZZZ Best, founded by Barry Minkow as a teenager operating out of a garage in Reseda, California, was a carpet cleaning company. Carpet cleaning is a legitimate, verifiable, low-margin service. A customer calls, a crew arrives, carpets are cleaned, an invoice is issued, and cash changes hands. The transaction is small, the documentation is thin, and the margins are characteristic of a labor service business. There is nothing structurally exotic about carpet cleaning. It generates modest revenue and modest profit, and it scales linearly with the number of crews and customers. This was the company's actual operating business, and on its own, it could not support the valuation that ZZZ's Best eventually carried. Layered on top of the real carpet cleaning business was a second, far larger reported business: insurance restoration. The premise was plausible on its face. When a building suffers fire, smoke, or water damage, the property owner's insurance carrier pays for restoration. A restoration contractor performs the work, bills against the insurance claim, and is paid out of the settlement. Restoration is a legitimate industry. The work is real, the contracts are real, and the margins can be substantial because the contractor is dealing with an insurer rather than a price-sensitive consumer. What made restoration the ideal vehicle for fabrication is precisely its structure. Consider the characteristics of an insurance restoration contract as a financial object. First, the counterparty is not the building owner. It is an insurance company or an intermediary adjuster, which means the documentation flows through third parties rather than directly between contractor and customer. Second, the jobs are large, often hundreds of thousands or millions of dollars, which means a small number of contracts can generate enormous reported revenue. Third, the work is performed at locations that are not the company's own premises, which means physical verification requires traveling to a job site that the company itself identifies. Fourth, the contracts involve a chain of paper: the insurance claim, the adjuster's authorization, the restoration agreement, the progress billings. Each of these documents can be produced independently of any actual work. What the legitimate version of this business requires is a real claim, a real damaged property, a real adjuster, and real labour and materials. The recharacterization replaces each of these with a document. The claim becomes a fabricated claim number. The adjuster becomes a confederate or a shell entity controlled by the perpetrators. The restoration agreement becomes a contract signed between ZZZ's best and an intermediary that existed primarily to generate paper. The progress billings become entries in the accounting system supported by invoices that reference no labour and no materials, because no labour and no materials were ever deployed. The structural insight is this. Carpet cleaning could not be faked at scale because it is too small and too direct. Each transaction is a customer, a crew, and an invoice, and the only way to inflate it is to fabricate thousands of small transactions, which is operationally impossible to sustain. Insurance restoration could be faked at scale precisely because it is large, indirect, and document-mediated. A single fabricated contract could represent revenue equal to thousands of carpet cleaning jobs. The fraud did not multiply small lies. It manufactured a small number of very large ones. By the time ZZZ Best approached its public offering, the reported financials showed insurance restoration as the dominant source of revenue. According to the SEC's enforcement findings, the restoration business that drove the company's reported growth and supported its market valuation was substantially fictitious. The carpet cleaning was real and small. The restoration was large and, in its decisive portion, invented. The recharacterization was complete. A labour service company had been presented to the public markets as a high-growth restoration contractor, and the valuation followed the fiction, not the fact. This is the architecture the episode reconstructs. How the paper was generated, how it was made to survive verification, and how the verification chain that should have caught it was instead enlisted to validate it. The construction of the fictitious restoration business proceeded through a sequence of structural steps, each designed to produce documentation that an auditor or investor would treat as independent confirmation. Step 1. The creation of paper counterparties. The restoration contracts did not arise from arm's-length dealings with established insurance carriers. According to the SEC record and the federal prosecution, the contracts were channeled through intermediaries presented as insurance adjusters or claims agents. These intermediaries generated the authorizations and the claim references that made the restoration jobs appear to originate from legitimate insurance settlements. Because the counterparty in a restoration deal is properly an insurer or its adjuster, inserting a controlled intermediary at that position meant the entire upstream documentation could be manufactured. An auditor reviewing a restoration contract would see a claim number, an adjuster's authorization, and a settlement amount. Each of these traced back not to an independent insurance company, but to a source that was part of the scheme. Step 2. The generation of contract documents and progress billings. Once the intermediary structure was in place, ZZZ Best could produce restoration agreements describing large jobs. Each agreement specified a damaged property, a scope of work, and a contract value. Against each agreement, the company recorded revenue and generated billings as if work were progressing. The accounting entries were internally consistent. Revenue recognized, receivables booked, billings issued. What was absent was the underlying economic activity. No crews were dispatched to most of these sites because for most of these jobs there were no sites in any operational sense. The contracts existed as documents, and the documents drove the accounting. Step 3. The management of cash to validate the receivables. A fabricated receivable presents an obvious problem. If revenue is recorded but no cash is ever collected, the receivables balance grows without limit and signals the fiction. The scheme addressed this through the circulation of funds. According to the enforcement record, money raised from investors and lenders was used in part to make payments that appeared to be collections on the restoration contracts. Cash that originated with ZZZ's best or with parties financing ZZZ's best was cycled through the structure so that it returned as apparent payment on fictitious work. The effect is that some receivables appeared to be paid, which validated the existence of the contracts in the eyes of anyone checking whether the money was real. The cash was real. Its source was not a customer paying for completed work. It was the company's own financing, recirculated. Step 4, and the decisive innovation, the staging of physical verification. This is where the Sacramento building enters the architecture. As the restoration business grew to dominate the reported financials, the auditors needed to satisfy themselves that the work was genuine. The natural verification procedure is physical inspection. Visit the site, confirm the restoration occurred. ZZZZ's best response was not to refuse inspection, it was to manufacture the inspection. According to the SEC record and the trial testimony, when Ernst Whinney sought to inspect a restoration site, ZZZ's best's principals located a large building that was real and recently completed. They arranged access through payments to parties associated with the property. They presented the building to the auditor as a ZZZ best restoration job. The finished condition of the building was consistent with the claim that extensive restoration had been performed and completed. The auditor inspected a real, physically existing, fully restored building. The building was not a ZZZ's best project. The restoration shown was someone else's construction, repurposed as evidence of ZZZ's best's work. Step 5. The confidentiality agreement as a procedural lock. Before inspecting the site, the auditor was asked to sign a confidentiality agreement. Consider what this device accomplishes structurally. The stated rationale was the sensitivity of the insurance restoration business and the confidentiality owed to building owners and insurers. The functional effect was to restrict the auditor's ability to independently contact the building's actual owner, the insurance carrier, or other third parties who could have revealed that no ZZZ's best restoration had occurred. The confidentiality agreement converted a verification procedure into a closed loop. The auditor could observe the building, but was constrained from corroborating its provenance with the independent parties who would have contradicted the staging. The single most powerful verification tool available, independent third-party confirmation, was procedurally disabled at the moment it was most needed. Reconstruct the org chart from these steps. At the base, a real carpet cleaning company generating modest, verifiable revenue. Above it, a fictitious restoration business consisting of contracts routed through intermediary entities that supplied fabricated insurance authorizations. Supporting the fictitious receivables, a circulation of investor and lender cash recycled to appear as customer payments. Protecting the whole structure from physical verification, a system of staged site visits using buildings restored by others, locked behind confidentiality agreements that prevented independent corroboration. And at the apex, a publicly traded equity whose valuation reflected the fictitious restoration revenue rather than the real carpet cleaning base. The scale matters because it explains the trajectory. By the time the fraud reached its peak, ZZZ's Best had completed a public offering and carried a market capitalization that, on paper, made Barry Minkow one of the youngest principals of a public company in the country. The valuation rested on reported restoration contracts. According to the SEC, a substantial majority of the restoration revenue was fabricated. The company was, in structural terms, a small carpet cleaning business wearing the financial statements of a large restoration contractor, and the gap between the two was filled entirely with paper. There is a further structural feature worth naming. The fabricated restoration business created a permanent financing requirement. Because revenue was recognized without corresponding genuine cash collection, and because cash had to be recirculated to validate the receivables, the scheme consumed capital continuously. Every reporting period that showed growth required new financing to sustain the appearance of collections and to fund the operations of the real business. A fraud of this construction cannot reach a steady state. It must grow, because growth is what justifies the new financing, and new financing is what the fraud requires to survive. The restoration business was not merely fictitious, it was a structure that had to expand or collapse with no stable equilibrium between the two. Why did the verification chain fail? The ZZZ's Best case is studied in auditing curricula precisely because the failure was not a matter of negligence by a single careless reviewer. It was a structural failure of the verification procedures available to the gatekeepers, and understanding it requires examining what each gatekeeper could and could not see. Consider the external auditor first. The auditing standards in force at the time directed the auditor to obtain sufficient competent evidence to support an opinion on the financial statements. For revenue, the standard procedures include confirming receivables with customers, examining contracts, testing collections, and, where appropriate, physically inspecting the subject of the work. The architecture of ZZZ's Best was designed specifically to defeat each of these procedures. Confirmation of receivables depends on the existence of an independent counterparty who can verify the obligation. When the counterparty is an intermediary controlled by or aligned with the scheme, the confirmation returns positive and confirms nothing. The auditor sent a confirmation and received agreement. The agreement came from a source inside the structure. The procedure executed correctly and produced a false assurance. Examination of contracts depends on the contracts being genuine. The contracts were professionally produced, internally consistent, and supported by claim numbers and authorizations. An auditor examining a restoration agreement found a complete document. The completeness of the document was itself the product of the fraud. There was no defect in the paper to detect because the paper was manufactured to be without defect. Testing of collections depends on tracing cash from customer to company. Cash did flow. According to the enforcement record, that cash was recirculated company and investor funds presented as customer payment. The auditor tracing a collection would find a deposit corresponding to a billed receivable. The deposit was real. Its true origin was concealed within the circulation of funds, and tracing the immediate source would not reveal that the ultimate source was the company financing its own fictitious revenue. Physical inspection, the procedure that should have been decisive, was the one most carefully defeated. The auditor, did not decline to inspect. The auditor inspected a building. The building was real and physically corroborated the claim. The staging meant that the most tangible form of evidence, direct observation, pointed toward the fiction rather than away from it. And the confidentiality agreement foreclosed the follow-up step that would have broken the staging. Independent contact with the building's true owner and insurer. This is the structural lesson the auditing profession drew from ZZZ's best. The procedures assumed a degree of independence in the evidence that the scheme had eliminated. Every confirmation, every contract, every collection, every site visit traced back through a channel that the perpetrators controlled. The verification chain was complete in form and corrupted at its source. For detection to have occurred earlier, the auditor would have had to step outside the channels the company provided and obtain corroboration from parties the company could not influence. Direct, unannounced contact with insurance carriers. Independent verification of building ownership through public records. Tracing of cash to its ultimate rather than immediate source. Each of these steps was available in principle. None was compelled by the standards as applied, and the confidentiality agreement was structured to discourage the most important of them. Consider next the underwriters and the market gatekeepers who facilitated the public offering and the financing. Their reliance ran in significant part on the audited financial statements and on the apparent growth of the restoration business. The fairness of evaluation, the willingness of lenders to extend credit, the appetite of investors to buy the equity, all rested on the reported numbers. When the auditor's opinion did not flag the fiction, the downstream gatekeepers inherited the false assurance. This is the cascade structure of financial verification. The auditor sits near the base. Underwriters, analysts, and lenders build on the auditor's work. A failure at the base propagates upward, and each subsequent gatekeeper treats the prior verification as settled rather than re-performing it. The restoration revenue was not independently re-verified by the underwriters. It was accepted on the strength of the audit, which had been defeated at the source. There is one further structural element in the detection failure: the use of confidentiality and proprietary justifications to limit inquiry. Throughout the scheme, the sensitivity of the insurance restoration business served as a recurring explanation for why ordinary verification could not proceed in ordinary ways. Confidentiality protected the building owners. Proprietary relationships protected the adjusters. The need to maintain client trust protected the contract details. Each of these justifications, individually plausible, collectively constructed a perimeter around the fiction that gatekeepers were discouraged from crossing. The structural observation is that a sufficiently large fraud does not hide from verification. It supplies a respectable reason why verification must stop short of the point at which it would fail. The confidentiality agreement the Sacramento auditor signed is the precise instance of this principle in operation. What would have had to be true for earlier detection? An auditor unconstrained by the confidentiality perimeter, willing to contact insurance carriers directly and without the company's mediation, would have found no claims corresponding to the restoration contracts. A tracing of cash to ultimate source rather than immediate deposit would have revealed the circulation. A check of building ownership through public records would have shown that the inspected sites were not ZZZ's best projects. The fraud was detectable. It was not detected because the verification procedures, as performed, ran through channels the perpetrators controlled, and the one procedure capable of breaking those channels, independent third-party corroboration, was the procedure most effectively suppressed. The unravelling of ZZZ's best did not begin with the auditors and did not begin with the SEC. It began, according to the public record, with a comparatively ordinary consumer matter: complaints concerning credit card charges. Before the restoration fraud reached its full scale, ZZZ Best had, according to the record, engaged in the practice of overbilling customers' credit cards in the early carpet cleaning operation. Some of these disputed charges generated complaints. A reporter at the Los Angeles Times pursued the credit card overcharging story. The published account, focused initially on the consumer billing practices, brought public scrutiny to a company that had been celebrated for its growth. The structural point is that the fraud was not first exposed through its central mechanism. It was exposed at its periphery, through a small and verifiable consumer practice, which then directed attention to the financial statements that the central mechanism had inflated. Once attention turned to the restoration business, the structure began to fail under examination. The financing requirement intrinsic to the scheme had not abated. The company continued to require capital to sustain the appearance of collections and to fund operations. As scrutiny increased, and as the company's access to new financing came under pressure, the recirculation of cash that validated the fictitious receivables could no longer be sustained at the scale the reported revenue demanded. A fraud that must grow to survive is acutely vulnerable to any interruption in its financing. The publicity created that interruption. The auditor's position changed as well. According to the public record, Ernst Whinney, in the course of its work and as questions accumulated, moved toward and ultimately resigned its engagement. The resignation of an auditor is, in market terms, a signal of the highest order. It communicates that the firm responsible for verifying the financial statements is no longer willing to stand behind them or to continue the relationship. For a company whose valuation rested entirely on the credibility of its reported restoration revenue, the departure of the auditor removed the foundation on which every downstream gatekeeper had relied. The SEC's involvement formalized the collapse. The enforcement record established that the insurance restoration business that had driven the company's reported results and supported its public valuation was substantially fictitious. The contracts, the claims, the adjusters, the collections, examined through the lens of an enforcement investigation rather than a constrained audit, did not correspond to genuine restoration work. The independent third-party corroboration that the confidentiality perimeter had suppressed was now obtainable, and when obtained, it confirmed the fiction. There were no insurance claims behind the contracts. There were no restoration projects at the represented scale. The receivables represented work that had not occurred. The company's market value, which had existed only as a reflection of the fictitious revenue, evaporated as the fiction was exposed. A business presented to the public as a large and rapidly growing restoration contractor was revealed to be a small carpet cleaning operation supporting a structure of manufactured paper. The equity that investors had purchased on the strength of the restoration business was supported by carpet cleaning revenue that could never have justified the valuation. When the restoration revenue was recognized as fictitious, there was no real business of corresponding size beneath it. The collapse was not a decline in value, it was the disappearance of value that had never existed. The criminal prosecution followed. According to the federal record, Barry Minkow was convicted on multiple counts arising from the scheme, and the conviction established in a court of law the fraudulent character of the restoration business and the methods used to sustain it. The conviction is the closed record on which this analysis rests. It is not an allegation, it is a finding. The stage site visits, the fabricated contracts, the recirculated cash, the intermediary structure, these were established as the architecture of a fraud, not characterized as disputed claims. Trace the sequence once more for its structural logic. The fraud was constructed to defeat verification at every channel the company controlled. It was exposed not by penetrating those channels, but by an entirely separate and peripheral matter, the credit card complaints, which redirected independent attention to the financial statements. Once independent scrutiny arrived, the financing requirement that the fraud could not escape did the rest. The recirculation failed, the auditor departed. The enforcement investigation obtained the third-party corroboration that the confidentiality perimeter had suppressed, and the fiction was named as fiction. The structure that had been engineered to be unbreakable from inside its own channels broke the moment verification arrived from outside them. What does ZZZ's best establish as a structural matter? First, it establishes that revenue can be fabricated at scale most readily where the underlying transactions are large, indirect, and document-mediated. The carpet cleaning business could not be meaningfully faked because it was small and direct. The restoration business could be faked precisely because it was large and routed through third parties. The lesson the case carries forward is about the structural properties of a revenue line, not about the character of the people who exploited them. Revenue that flows through controllable intermediaries and resists direct physical verification is revenue that can be manufactured, and the auditing of such revenue requires corroboration that steps outside the company's own channels. Second, the case demonstrated that physical inspection is not self-validating. The auditor inspected a real building, and the inspection confirmed the fraud. Direct observation is persuasive precisely because it is tangible, and that persuasiveness can be weaponized when the thing observed is staged. The case established that physical evidence must itself be corroborated as to provenance. Observing that a building was restored proves nothing about who restored it or whether any insurance claim ever existed. Third, ZZZ's best became a defining illustration of confirmation risk and of the use of confidentiality to suppress independent corroboration. The confidentiality agreement the Sacramento auditor signed is the case's enduring structural artifact. It shows how a procedural device, justified by a plausible business rationale, can disable the single verification step capable of breaking a fraud. The auditing profession's response, reflected in the evolution of professional standards and in the treatment of related party and confirmation procedures, drew directly on the recognition that the evidence channels a company controls cannot be the sole basis for assurance. The auditor's response to fraud risk, the requirement to consider whether arrangements lack apparent business purpose, and the heightened scrutiny of revenue recognition all carry the imprint of cases like this one. Fourth, the case establishes the cascade property of verification failure. The underwriters, the lenders, and the investors relied on the audited statements. When the audit was defeated at its source, the false assurance propagated through every gatekeeper above it. No subsequent reviewer re-performed the verification that had failed. The structure of financial verification is a chain in which each link relies on the integrity of the one below it, and a corruption at the base is inherited by all that build upon it. ZZZs. Best is, in this sense, less a story about one company than a demonstration of how assurance flows and how a single defeated procedure can carry false confidence to the top of a market valuation. The findings are these. A real but modest service business was recharacterized through manufactured documentation into a large fictitious contract business. The fiction was protected from verification by intermediary counterparties, recirculated cash, staged physical inspections, and confidentiality agreements that suppressed independent corroboration. The verification chain failed not through individual negligence, but because every procedure ran through channels the perpetrators controlled. The fraud, structurally required to grow in order to finance itself, could not survive the interruption that arrived from its periphery. And when independent corroboration was finally obtained, the restoration business was established as substantially fictitious. The valuation built upon it disappeared, and the conviction closed the record. The carpet was real. The restoration was paper. The market priced the paper, and the paper was the fraud.